So, if you're new to this, I'm Mitchell Hora. I'm the founder and CEO at Continuum, and I'm a seventh generation farmer based in Southeast Iowa. And at Continuum Ag, we're a software company that is really focused on improving family farm profitability via helping to improve soil health. One of the big ways that we're chasing improved profitability is through the 45Z tax credit, carbon intensity analysis, and helping farmers verify their CI scores. But there's a lot of other things out there too. And that's where there's different tax credit programs and whatnot, just different tax programs, and all credits, I shouldn't say that, but
Yeah.
different tax clauses, different programs out there, cost share initiatives, R&D, residual fertility, the 45Z stuff, other carbon programs, and just good old better agronomy too. That's what so much of this boils down to is just control your input costs and continue to drive as much outcome as we can in a balanced manner that is just profitable by itself. And I think a lot of times we get too complicated, but keep in mind that really it is um, just some of the basics sometimes is what we need to be focused on. So, continue working on an array of different things, but ultimately, this is all about I'm always looking for new things that I can bring to my family farm, ways that we can drive our profitability, ways that we can improve our soil health. And if it helps me, hopefully it'll help you too. So that's why we're here. And one of the best in the business of being able to help farmers, and especially when we're talking about taxes, when we're talking about IRS, tax code, all this stuff that I sure don't want to be the expert on. That's why I lean on guys like Paul, who is the expert and is in this world all day, every day. He's the farm CPA, big footprint online. He's got his podcast as well, putting out a ton of content. We've cross collaborated multiple times, so excited to get Paul back on because there's a lot of very interesting updates, particularly regarding the One Big Beautiful Bill from July. A lot of impact on that, so we're gonna dig in there. But let me stop sharing this for now. Paul's going to share in a little bit. For everyone that's on, use the chat, use the Q&A. We really want to get your questions asked here. I'll try to ask as many of my questions and whatnot as we go. But everybody that's on, feel free to jump in. Also, reminder that this is being recorded. We'll put it out on our YouTube page, put it on our podcast, the Topsoil podcast. Just trying to get this content out there for anyone who can't make it today. But Paul, maybe just give a quick intro and background for maybe the couple folks that maybe don't know you, and then we'll roll from there.
Yeah. And I noticed in that first slide you had up there, I'm not sure if you or I were squinting more in that photo. So,
Yeah,
yeah, so
I've been accused of being very squinty before. Yes, and then
yeah,
my wife
well,
gives me crap because now my kids, especially my daughter, she got my squintiness.
yeah, well, and I was outside when that photo was taken. It was very sunny. So, but just brief background. I grew up on a farm in southeastern Washington State, but I've been a CPA my whole career. I started a blog back in 2009. I continued to blog. The current blog's farmcpareport.com. But I write a column for Top Producer magazine. I speak across the country. Matter of fact, yesterday I was speaking in Minneapolis to a group of CPAs, probably on the road about 100, 125 days out of the year, speaking about farm taxes. And I like to learn stuff myself. So, and I have farms in Washington, Iowa, and in Missouri. So, not large farms, but probably own about 1,000 acres. So it's enough to keep me busy.
That's great. Yeah, Paul, I do think this is one of the few times that you and I have each been in our offices to record something.
That
Might be the
could
first
be,
time.
yeah, might be, could be, yeah, because you've been in a pickup a few times, and I've been on the road.
A
So
lot of
yeah,
times we're calling from our hotel rooms and whatnot.
yep.
But anyway, no, really appreciate you coming back on, Paul. Let's start with the research and development tax credits. Continuum's been pushing on this a bunch. Now you got some background in it, but give kind of your take on the R&D credits, particularly, of course, how they impact farmers.
Yeah, so a farmer that is actively involved in doing new things, doing research, doing development of new agronomy or livestock, new types of hog breeding, cattle breeding, dairy breeding, whatever it might be, that qualifies for what's called an R&D credit. And the credit can be, you know, and what we have to understand though is you have to be sort of increasing that research and development. The idea is we're trying to promote you to do more R&D. So simply doing one thing and then thinking you're going to get that credit, continuing to get that same credit is not going to work. So now the expenses that typically qualifies, the labor related to that R&E, or I'm going to use R&D,
Yeah.
R&E, R&D, it's sort of synonymous. R&D expenditures, so it'd be any type of labor that's specifically related to that research, any of the outside consultants like Continuum Ag that you might pay, the cost of supplies. Now that could be some of your seed. It depends on who's doing the study as to how much of that seed they're going to use, or genetics, how much of the semen, the AI that you might be doing. So you add all those costs together, you then review those costs compared to like a baseline. So that extra amount above and beyond the baseline, typically roughly around 20% of that difference is allowed as a credit. And again, Mitchell, I know a lot about taxes, but I'm not a expert. I don't specifically am an
Yeah.
expert in R&D, but that's sort of the general 30,000 foot view of how it
Well, I can
works.
add on to it a little bit from my perspective, right? We Continuum has been doing R&D credits for years, as we've been developing
Yep.
software, doing
Yep.
on-farm research. Shoot, we've used it for years. I
You're
just
the
did,
perfect
yeah,
type
we're ideal.
company.
Yeah,
Yes.
so
Yeah.
how we use it, right, is we have employees where a certain percentage of their time is dedicated to these research and development activities.
Yep.
So if I've got, an employee where they spend 30% of their time doing R&D, then I can take 30% of their salary and categorize it as a R&D
Correct.
wages rather than just regular wages. I
Yep.
can still deduct it from my taxes, right,
Yep.
as a
Yep.
business expense, but then I also get this credit. And to your point, there's a federal credit that usually is anywhere from 6 to 8%. We're seeing about 7% of the expenses on average. Then there's states as well, where you can get a state tax credit, and that's where you're getting close to that, kind of
And
15,
and it's good to say
20%.
that 6 to 8, because the actual credit can be, I think it's 16 or 20, depending on whether you're deducting or not deducting, or backing out the expenses. But again, it's that above that base amount. So if you're just looking at your total, if you assume around 5, 8%, you're
Yeah.
probably pretty close.
And that's what I'm
But you have to
referring
go
to,
through
right?
all
Of
those
when
calculations.
it's a basic account. I think of it as just an accounting concept, right? I was gonna spend money doing business. It's just of the money that I spent, what of it can be kind of earmarked as
Yep,
research and development.
exactly,
Right.
exactly.
And so, like what you were just talking, we're working through it on our own farm. We literally just met with our guys the other day. And this year we had a bunch of new hybrids that we're
Yep,
trying. Well, those
yeah,
are new to us, experimental hybrids. So the cost of the seed can be qualified under R&D, and then our labor going into
yep,
planting the seed,
yep.
harvesting the seed, that can count. We
Scouting the
cannot
seed, scouting the seed,
scouting some of
or
those if
scouting
we
the
were paying
hybrids.
for it, if we were
Yeah,
paying
yep,
for it. So
yeah,
if we had a third party where we were actually taking an expense, what we're running into on our farm is kind of the paper trail. At least this has been my experience so far. Maybe we're uh, I'm still learning. I'm very new to this
yep,
too on
yep,
the farmer side. But dad is the employee, right? He pays himself a salary, but he pays himself a low salary.
yeah, yeah,
And because of course farmers, we're paying ourselves in a variety of different ways with rent and other things, right? And salaries are subject to Social Security withholdings.
yep,
So
yep,
we're typically trying to keep that low, but of his labor, of his efforts, you can't exceed what you're paying yourself in a
right,
salary,
yep,
right?
yep,
If you were an operation where you were hiring in a W-2 employee or a 1099 employee to come in and do the planting of the trial for you, do the consulting on it, do the scouting on it, do the harvesting, there could be more of those expenses where you can have an actual line item
yep,
in your, on your QuickBooks or PC Mars or whatever
on,
accounting platform
on
you're
your chart
using,
of accounts. Yep,
on your chart of accounts, it's categorizing, is it a regular expense? or is it an R&D expense? And I think we just have to continue to learn and go through those. What I was getting at on the planting and harvesting, we can't you can't use the R&D stuff on like the equipment that you are already deducting or
Right.
depreciating
Yeah.
the equipment. So a depreciable asset that you're paying for that, you can't also count that as a variable expense.
Yeah. Yeah.
And that's really the key. At least my
Yeah. To
overall
me, the
takeaway on R&D,
three,
it's variable
yeah,
expenses
yeah,
associated to
yeah,
R&D inputs, labor, that kind of
yeah.
thing.
Yeah. The three key ones: labor, supplies, or
Supplies.
the inputs, and then the outside consultants. Those are the
Outside
three
consultants,
key,
some
key.
technology stuff too.
Yeah. Yeah.
If you were using some kind of a sensor or third
Yeah.
party stuff,
Yeah.
if
Yeah.
it's a if you know if it's a planter upgrade that
Yeah.
you're depreciating, that doesn't count.
Yeah. Yeah. But if you're renting a special planter just to
Yeah,
plant that crop, that would typically be a cost that you could use.
yeah.
So, yeah.
And so we've been having pretty good luck with it. And yeah, Paul, on average, we're seeing farmers earning back in their pockets about $10, $11 per acre
Yeah.
per year.
Yeah.
So
I
I
would
mean,
say
it's
that's probably a pretty good average. Plus, you can go back 3 years. So
yep.
you can go back to your open years. So right now, 24, 23, and 22 would be what we call open years.
Yep.
So the company doing the analysis could do 22, 23, 24, and 25.
Yep.
Now you have to file a minute returns and so on. That can be a little bit of a hassle, but if the dollars are big enough, it's worth doing.
That's right. And that was part of the big beautiful bill. We're going to talk more about that, right? But
Well, no,
that
the
look
big
back to
R&D has been around for quite a while. What happened
right.
in the big beautiful bill is during 22, 23, and 24, you had to capitalize your R&D expenses and then amortize it over 5 years. Now that's gone back to immediate expensing. So that's really the big change in the one big beautiful bill.
And to explain that, if you had call it $100,000 of R&D expenses before a big beautiful bill, you had to take that $100,000 and spread it out over a 5 year period.
Yep.
So
Yeah.
therefore,
Yeah.
then on your expenses, you only get $20,000 per year, and
Yeah.
then you don't have all those expenses to offset your income, and you could actually have a tax
Yeah.
liability
Yeah.
increase.
Yeah.
Well,
Yeah.
now they fixed that you can recognize all those expenses in that year,
Yeah.
plus you get the credit. And I think of it basically as it's just encouraging more R&D, right? It's
Yeah.
encouraging being
Uh,
experimental, it's encouraging learning, and the credit is there to help offset some of the risk of doing something different.
Yeah, and on the credit, you can either take a larger credit, but then you have to reduce your expenses by that credit, or you can take a smaller credit where you don't have to reduce the expenses. And typically, when I was doing it, I typically did the smaller credit because from an after-tax standpoint, it was better off for the client.
Yeah. And the question here asking, are we going back to 2022? I don't think we are going to go back on our farm. We're a small enough operation. The amount, it looks like it's going to be okay.
Yeah.
We'll
Well,
have
and the
we're going to
record
end up with
keeping,
about $100,000 of qualified
yeah,
expenses,
yeah,
which is going to be good. But how we're looking at it is my understanding, Paul, as we were going through this the other day, was if you were paying taxes over 22, 23, 24. If you were paying taxes, then you'd have to go back and do the amendment, and it could be additional cost there. Is it going to be worth it?
yeah, yeah,
You'd have to run the
exactly.
numbers and see.
Yeah,
If you weren't paying taxes there through, whatever, you weren't showing significant taxable income, then you don't necessarily have to go back because you already weren't paying any taxes. Now you have additional credit that would have just
that
been
carries
banked up
forward. Yeah,
anyway. Now you can recognize that credit on your 2025 return, and then you could hold on to them going forward and whatnot. But so I
it's
think,
always going to be taxpayer specific, whether it
yeah,
makes sense to go back or not. Sometimes it
that's
makes
right.
sense, sometimes it doesn't.
Yeah. So I think for our operation, we're probably drawing the line in the sand here for this year, and then, continuing to look at this and utilize going forward. But exactly like you said, you got to kind of have the conversation with the folks, and yeah, we've got some partners we've been connecting farmers with. We've got a little form that farmers can fill out, get connected with our partners. They walk you through the numbers, show you an estimate of what would qualify, what the amount may be. And like I said, we're working through that process in our farm, looking like it could be close to $100,000. They then say, okay, here's what the percentage
Credit.
of that would
Yeah.
be,
Yeah.
right? Somewhere for
Yeah.
us, it's going to be in that 12 to 15% or so when we're
Yep.
looking at federal and state. That's not a bad chunk. And then, the company, of course, they get a percentage of that. They're
Yep.
going to get
Yep.
a revenue share of sorts
Yeah.
at the end. And it's like, yeah, I mean, it's just utilizing the
What the
tax
tool that's
code that's
there.
already
Yep.
there. It's a tool that's there.
Yeah.
And as farmers and any businesses, we don't want to pay any more in taxes than we have to.
You mean
And so
farmers do not want to pay taxes?
definitely not.
I've never heard that before, Mitchell. I've never heard that.
Yeah, yeah. As farmers, we're pretty good at it too.
Yeah. Yeah.
A
Yeah.
lot of farmers are
Yeah.
quite good at it, but there's just a lot of moving parts, right? And
Yep.
that's where this is another one. I think it's going to take some additional practice, kind of getting used to it.
Yeah.
And at least I think there is, unfortunately, in this credit, there's a bit of a size requirement as
Yep.
well. If you're
Oh,
a
yeah.
really small operation like my farm, probably not enough there to cover the cost of a
Yeah. Yeah.
CPA
And the
firm
hassle.
doing.
There's a little bit of a hassle. I
There's
mean,
a hassle.
it's not just the dollar cost, it's the time cost,
Yeah.
it's the documentation cost. So
Yeah.
you just got to be, like you say, I think you need to have a decent amount of those
Yeah.
type of expenses to be worth your
But if you're
while.
at least, 500, especially 1,000 acres or more,
Yeah. Yeah.
it's definitely
Thousand, two
worth,
thousand, 5,000 for sure. Yeah.
especially as you're bigger.
Yeah.
It's 100% at least worth the
Yeah.
consultation
Yeah.
to
Yeah.
figure out
Yeah.
what would it, what will this work? Will it be worth it? And especially if you're using some software to track your business
Yep.
expenses anyway,
Yeah.
it's just recategorizing things and providing that documentation, like you said, to prove that it was a R&D expense. So,
Yep. Yep.
anyway, yeah, I definitely I think something that's important to note. And yeah, by deducting those expenses in that calendar year and getting the credit, hey, if you're doing some innovative stuff, might as well get rewarded for it.
Yep. Exactly.
Um, One of the other things that one hit on before we pop up some of your slides is the residual fertility deductions. You've spent a lot of time on this one, Paul. Maybe explain residual fertility deductions just a little bit. And I just saw a headline that in the month of December in Iowa, there's like 3,000 acres of land that's up for sale in or that's going to be selling in the month
Yeah.
of December here in Iowa.
Well, it
A
may
lot
be
of
more than
land.
that. I mean,
That was just
it's
what's like publicly available, right?
yeah,
And like
yeah.
what's
So
going to auction.
yeah, so anytime that you purchase land or inherit land, uh, part of that land value related to that land is the fertility. I'm going to use the word fertility.
Yeah.
IRS, in a private letter ruling from 30 plus years ago, used the term excess fertility. I personally think it's all fertility, but the studies use excess. And really, what it says is what's the value of your nitrogen, your iron, your boron, your calcium, your phosphorus, your potash, whatever it might be, phosphate, et cetera,
Yeah.
magnesium, add all those values together. And if your basis in that land's high enough, if you're buying land for $1,000 an acre, you're probably not going to do this study because it's not worth the cost. But in Iowa, I mean, the average land and value in Iowa is probably $8,000 to $10,000. You're probably looking at about a $1,500, maybe $2,000 deduction. Now, this is a deduction. Typically, it is amortized over approximately a 7-year period. Some CPAs view the under code section 1080, or excuse me, 180. You can deduct it in the year of purchase if you're a farmer, and it has to be on a timely filed return and so on. Now that code section is only about 2 paragraphs long, so it's not. We don't have a lot of guidance, and I'll tell you right away, we do not have a lot of guidance from the IRS on this. This deduction's been happening for 30 plus years, but in the last 5 years, I think technology and there's just a lot more companies out there. I'm going to use the plural
Yeah.
that are doing these studies. Now, some of the studies I've seen maybe a little sketchy. Some of them are much better done, but it's still evolving. But if you are buying land, especially in 2025, if you're buying land and you want to be able to get an extra deduction, you probably should reach out, whether it's through Mitchell's company or any of these companies, reach out and say, hey, what might be up my deduction? And they can give you a pretty good ballpark
Yeah.
pretty quickly
That's
as
right.
to what the deduction would be.
That's right. We've got a company called Legacy Soil that we're working with here at Continuum, where, yeah, if you are buying ground or inheriting ground, what you need to do is get it soil sampled.
Yep.
And it's
Yep.
just usually just, 2.5 acre regular, 2.5 acre grids, regular traditional soil analysis is fine. We just need that, the lab data.
Yep.
And yeah, can plug it in and be able to run these calculations pretty quickly. And basically, what it's looking at is what is the value of the fertilizer that you just purchased, right? So
Yep.
it's splitting out what you bought, right? You
Yep.
bought land, which has value, but then it's splitting out that the fertility in the land kind of has its own separate value.
Yeah. So when you buy land, there might be tiling in that
Yeah.
land. Well, we're going to split out the value of the tiling. There might be fences. There could be a grain bin. All of that cost segregation
Yeah.
is really what we're doing.
Yeah, it's segregating the costs. Then it's looking at, okay, within that fertility that was there, what's the value of it? And so where the sketchiness comes in on this, like you're saying, is some folks are overvaluing that
Yeah. Yeah.
or
How deep
taking
are
it
you
a little
going? Yep.
too
Yep.
aggressively on
Yep.
how they are recognizing the useful life
Yep.
of the
Yep.
fertility and
Yep.
whatnot. So,
Yep.
so that's where we've been, like I said, working with Legacy Soil, trying to do this in a manner that avoids risk of
Yep.
getting audited, getting somebody
Yep.
in trouble, trying to be realistic and coming about it with more of a real like
Yep.
agronomic
Yep. A
component.
scientific economic basis.
Yeah,
Yep.
so
Yeah.
really trying to do that, cross the T's, dot the I's, because to your point, it's a IRS tax credit. The IRS, sorry,
Deduction.
I
You
keep
need
I always
deduction.
my bad. A deduction, not a credit. So
Yeah.
you deduct those the
And,
value
and
of it
and remember, it does
deducted
reduce
at your
your
tax
bait
rate.
and it reduces your bases in the land. So when
Yep.
you sell it later on, you're going to have recapture. Now, many farmers, I'm never going to sell or I'm going to do a 1031.
Sure.
I'll get a step up when I pass away. That's fine. You will get a step up at that point.
Yeah.
So
But then even those folks that are
inheriting
inheriting
it
that, you
can
have the
then do
step
it.
up in the
Yep.
basis and you have the fertility that comes
Yep.
out of that, and it's going to help in
Yeah.
future
Just
generations.
like tiling, when you pass away, if you got tiling in the ground, your heirs then get to depreciate that over
Yeah.
15 years. So,
Yeah, yeah.
yeah, yeah, on the
So yeah,
tiling.
if you're buying some ground, if you're inheriting ground, absolutely worth looking into here
Yep.
once again.
Yeah.
And I mean, yeah, to your point, Paul, like you said, this can be $1,000 an acre or more
Oh,
in
yeah, yeah,
value.
yeah. I would say the average I see is around 1,500, 1,700, something like that. I mean, I've seen numbers a lot higher than that. I
Yeah.
mean, I've seen 10,000 plus, but
Some of that
I'd
gets a
say,
little aggressive.
yeah, yeah, and again, if your basis in the land is low, we're still wanting to deduct probably no more than 35% or so of the cost basis of that land.
That makes
So,
sense. So when you're
yeah,
buying ground, a third of it being attributed to the fertility, and
is
then
sort of the max where I'd be
as the max.
comfortable.
That makes
Yeah.
sense. Yeah, that
Yeah.
makes sense.
Okay.
So okay, let's turn over to your stuff.
Yep.
We're digging deep into this, but
I'm,
yeah, if you're
I'm,
doing innovative R&D stuff, I'll pop up a deal here later. Paul, why don't you pop up your slides? Hopefully,
I'm
we've
gonna
got
pop it right
you
here. I'm
able
going to
to.
share.
Perfect.
Did the slides come up?
Looks great. Looks
Okay.
great.
I'm gonna
So
bring it over here in front of me so I can see it.
looks,
Okay.
looks good on our side, but yeah.
Yep. So I'm
And
just
folks, continue to pop questions in the chat. Hopefully, I'm getting to them for you as well. But
Yeah.
yeah, fire away, Paul.
So I just want to go over some of the key provisions under OBA. I call it OBA. Some people call it ABA. Some people call it OB3, whatever you might want to call it. But remember the reference price for corn and soybeans. That's primarily probably who the listeners on this call are probably corn and soybean farmers, but there's other crops too, wheat for me, dry peas, chickpeas, and so on. The reference price was set back in 2014. It was never increased. It was never updated. Now, in the 2018 Farm Bill, we had what was called effective reference price, where it could go up by 15%. Now, OBA bumped up all the reference prices a minimum of 10%. Unlike rice, it was 20%, but corn was about a 10% bump. Soybeans were, I think, about 15% or maybe a little bit more. But on top of it, they then rejiggered or redid the calculation of the effective reference price before you took the Olympic average price of the mid-year average from USDA. And mid-year average or the Olympic average just means you throw out the high, throw out the low of the last 5 years, take the average of the three. Now, before they were multiplying that by 85%, now they're multiplying it by 88%. So we're getting a boost on that floor price, so to speak, but it still couldn't go more than 15% higher than the reference price. Now, starting in 2031, we have an automatic 0.5% increase in the reference price each year, but over time, it can't exceed more than 113% of the current reference price. So just give you an example, corn was at 370 back in 2014. It's now at 410. The maximum 113% of that's about 460. So over time, that reference price will continue to go up. And then on top of it, that 460 could then be 15% higher if the market prices start going up. So that's,
So
I just
these
wanted to,
increase Title One programs,
these are
right?
Title
Where you
One. So here's all the, so on this screen here is every single Title One program that we have. Now, as you can see from the number of acres, obviously corn is the big dog, so to speak. There's 92 million acres of corn. That's also probably why we couldn't increase the reference price any higher than they did, just because it would throw their budget out of whack. Wheat is second at 61 million base acres, even though we haven't planted 61 million base acres for a long time. And then soybeans are at 52 million base acres, but we've always planted in the last 10, 15 years, 80, 85, 90 million acres.
Okay.
So base acres is what you're paid on. Planted acres really are sort of irrelevant when we're talking Title I payments. So what I did on this, I'm just showing you what the average PLC yield is for all the crops, because remember, PLC has a static yield. It isn't based on what the county yield is. It isn't based on what your current yield is. It's based on a yield that was set back in 2014, plus maybe some minor adjustments. So what I'm doing in this chart is I'm just trying to calculate where I think the payments for 2025 are going to be. They're going to be paid out in October of 2026. Now, I had many farmers, Mitchell, reach out to me and say, hey, they're changing the rules. Back in March, I signed up for ARC and PLC is going to pay a lot more. I'm going to get screwed, excuse my language. I'm going to lose money. Well, Congress said, well, we understand that. We're automatically going to pay you the higher a PLC or ARC. Now, interesting, University of Illinois and the Farm Doc Daily just came out today. So if you don't subscribe to the Farm Doc Daily, I would highly recommend it. They came out with their estimates of 2025 ARC/PLC payments. Now, my numbers, because I've been updating this is September numbers. I've updated it for November. It's about 2 billion less than what I'm showing. It's about 11.9 billion. Their number was at 13.5 billion. Now, what's the difference? Most of my numbers tie with theirs versus a little bit of rounding. It's a little bit of rounding, and they got a lot more students behind them than I do. But notice on this chart, corn ARC payments might be higher than PLC payments. Soybean ARC payments might be higher than PLC payments. Now, what I don't know, University of Illinois, I think they use maybe benchmark average yields or some type of average yields. We know that corn and soybean yields this year on average are at least 3 or 4 or 5% higher than they've been before. So I think PLC numbers for soybeans is likely going to be the payment. Now, interesting, this was at 1010. USDA just bumped the soybean price up to 1050. Mitchell, we're seeing a rally in soybeans. We may not have any payment on soybeans next year at all. And on corn, they bumped it from 390 up to $4. Every 10-cent increase in the MYA price results in about a $1.2 billion reduction in payments. So if corn goes back to 450, we're probably not going to get any payment for corn. So
because the PLC is based on price.
PLC is based on price.
Yep.
The current effective reference price for corn is like 442. So at 390, we were looking at a 52-cent payment. If corn final MYA price is at 450, we're looking at a 2 cent payment
Yeah.
on PLC and nothing on ARC.
Yep.
So on average.
Yep.
So now
So those are the
yep,
numbers that you're projecting right now, but it
yep.
could end up being less, is what you're saying.
Well, this was my September numbers. I didn't have a chance to work up new slides because that just came out a couple of
Yeah,
days
yeah, but
ago. We're 2 billion lower than
2 billion
this number
lower.
already.
Yeah,
So, and
got
that's
it.
just because of corn and soybeans.
Mhm.
Now, base acres have been around for a long time. Probably base acres have been around longer than you've been alive, Mitchell. So it's been around quite a while. They've never been increased. Back in 2014, they were able to be reallocated between corn and soybeans and wheat and so on, but you couldn't increase them. They're now going to automatically add in 30 million base acres. We have about 242 million now. We'll end up with about 272 million. What does that mean for farmers? Well, that means on average, they're going to collect an extra 12%. Because remember, you get paid based on base acres, not planted acres.
Mhm.
So you're going to get an extra 12%. So this is sort of the details. Just because of time, I'm not going to go through all the details. But this is an interesting chart. This is actually from FAPRI down in University of Missouri. Right now, we have corn base acres of about 94 million, or actually 91 million of base acres. Under this reallocation, we're going to end up with almost 102 million base acres of corn. Notice on soybeans, we're about 52 almost now. We'll be at 59. We're still nowhere near planted acres. And then on wheat, we're still going to increase wheat base acres from 62 million up to 69 million, even though we haven't planted more than probably 40 million acres of wheat for 20 years. So it's just
And
interesting how it works.
and they do the base acres really from a budgeting
Well,
purpose. Is
it's a
that why?
budgeting.
Like,
Well, it's budgeting and politics. Look at rice. Look at peanuts. Look at cotton. Well, not cotton's probably okay, but notice that their base acres are substantially higher than
okay,
planted acres.
yeah, yeah,
And the highest payment per acre right now is on rice and then peanuts. And so if you were to reallocate acres to what they actually plant, you'd have the southern farmers out there screaming, hey,
hmm
we're losing payments, and that's the reality. So that's why they've never really they've allowed farmers to elect to reallocate acres, but they don't mandate it. So that's why it's the way it is. So okay. And then we, in the past, if you were an LLC or an S corporation, but you had multiple owners, you were sort of limited to how much of a payment you could receive from the local FSA office. That was one payment, 125,000. But let's say you had four equal owners, they're all actively involved, they're all farming in an LLC, large farm operation. Under the old rules, if they were farming as a general partnership, they qualified for 500,000 payments. Under Whereas if they were an LLC, only called for 125,000. They've now eliminated that distinction. They have what's called a qualified pass-through entity. So any S corporation, any entity taxed as a partnership, any LLC not taxed as a C corp, any general partnership, any qualified pass-through, or any qualified joint venture, they're all subject to multiple payment limits.
okay.
So this is really good news. We can start getting rid of a lot of these partnerships that's got weird LLCs and S corps as owners. We can get rid of all that stuff. We can get rid of a lot of tax returns. I'm a CPA. I want to get rid of tax returns when they don't make sense.
Yeah.
So
So
we
this
can
is if you're a corporation, that's still just one, right? If
C
you're a C
corporation
corp,
still
still
one.
one,
So
but
S
basically
corp,
everything else is tied
yeah,
to the owners.
yeah. And there's a lot of C corps out there that are probably right now actively discussing, considering switching over to an S corp because
Sure,
of payment limits, especially if
sure.
they have three, four, five equal owners. They are really reducing their payments as a C corp. They really need to be looking switching to an S corp.
But those
Now,
owners need to be actively involved.
actively involved, and they need to be equal owners, and I'll show you that
Okay.
here in a second. Now, I was going to say something, but I'll
But some of
might
the
jog my
so some of the
memory.
where it would be important here is some of the folks that are on this that if your farm is currently a C corp and you have multiple owners that you farm with, you may want to reevaluate
Yep.
not being a C corp. Now, it really only matters if you have substantial acres and stuff and you're
Right.
maxing out
Yep.
those limits
Yeah.
anyway. right?
But these
So,
days, based on the estimates, if you farming 3,000 acres, you're probably looking at going over one payment limit,
okay.
probably depending
So,
on your yield and so on.
yeah,
But
3,000 acres or
yeah,
so.
yeah,
C Corp be looking to change,
yeah.
potential to
If you're
change.
farming 10,000, 15,000 acres as a C corp and you got multiple active owners, you definitely would want to
Definitely would
consider
want to change.
switching to an S
Got it.
corp.
Got it.
Yeah. Now, many of these programs, such as SDRP, Supplemental Disaster Relief Program, Stage 2 was just announced on Monday. They allow you to get an extra payment limit if more than 75% of your adjusted gross income is from farming. But the definition of farming under the old rules, equipment gains was very difficult for it to be considered farm income. Well, OBA said now, starting with 2025 crop year, we believe, it's automatically farm income. Um, oops. Oh, well, no, I know what I'm saying here. We still don't know AGI testing on LLCs and S corps. They may change that definition. What I was going to say before is the qualified pass-through entity. We think it counts for the 2025 crop year, but FSA really hasn't got out the transition guidance.
Okay.
Same on AGI testing. That's the only thing I was really saying here.
So some of that
But
you're saying could be some of these changes could be subject to 2025 crop year, or
Or
they'll just be punted
26.
until
Yeah, yeah,
26.
yeah. Because of the fact that it's midway through the crop year, it's a little tough for them to effectively make some of these changes. So we'll see. We know for 26 it's going to apply. 25, we're just not sure. So we're telling a lot of people, let's not make any major structural changes until we know the guidance, because even if you switch from a C Corp to an S Corp, that still is too late for 2025. Although you can do a late election for 25 for tax purposes, but typically you had to let the FSA office know by June 1 what your structure was. Are
Sure.
they going to give you some transition? We just don't know. Now, if they kept the payment limit at 125,000 and made all these great changes for a lot of farmers, no benefit really. They're going to be maxed out. They bumped the payment limit to 155,000. Starting next year with the 26 crop year, it'll be indexed to inflation. So this is a pretty good deal. Now, what I wanted to share, just show, let's say we have an S Corp or an LLC with four equal owners. They're all actively involved. They're large farming operation. They're hitting the $620,000 payment limit. They don't have any reduction because their ownership is equal. Now, look at it if their ownership is not equal. Let's say owner one's got 37%, owner two's got 18%. You're seeing we have to allocate that payment based on the ownership. So owner one's going to get 229,400, but his social security number only allows you 155,000.
Oh, yeah.
So as you look at this process, you're going to lose about $80,000 of the payments. So that's why just adding somebody into your farm operation and giving them a 1% ownership doesn't really change the bottom line on payment limits. Also, remember under FSA rules, it's got to be substantive and what they call bona fide. Just adding somebody in the operation, if you're not growing the operation by, let's say, 20% of acres, you may not get any extra payment limits. So you
So
just
I'm
got to be
thinking on
careful
this
to
would
meet.
be like if a farmer has all of it under him and then he's going to add his wife in to try to play the game a little bit.
Now,
You,
wives are different. Wives
oh,
you
okay.
can add.
Okay.
Wives, you should be adding your wife.
So
Matter
this
of
is
fact,
adding a son, adding a
this is
kid into the
son or
operation.
yeah, exactly,
Okay.
exactly.
Okay.
Um, this is what I was starting to talk about. Under the old rules, gain on sale or trading in farm equipment was not considered farm income in most situations. Now, OBIT automatically says it's farm income, agritourism is farm income, and direct to consumer marketing of farm products is farm income. This is good news. This has been painful for us as CPAs to tell a farmer that they're not a farmer. That's not a fun conversation to have, but it's the FSA rules. So
Yeah.
this
Yeah.
is going to be good news. Now, I just wanted to go through some of the key income tax changes and then hopefully maybe have a few minutes for questions. The lifetime exemption was going to drop back to about 7 million, a little bit more than 7 million. Well, starting next year, it's permanent, which means until Congress changes it, but it's permanent at the $15 million level. That means a farm family couple could be worth 30 million. Really, they could be worth about 40 million with a little bit of planning and not owe any federal estate tax. Now,
Okay.
if you're in Illinois, if you're in Minnesota, if you're in Washington State, Oregon, New York, the states that have estate taxes, you still worry about that at a lower level, but at least at the federal level, we don't have to worry about that. So that's
This
really good
is
news.
this is death tax, right?
Yeah,
It's kind
death
of
tax.
how most of us think of
Yeah,
it, right?
yeah,
So
exactly.
increasing the death tax from or increasing the death tax up to that 15
Exemption. Yep,
million
yeah. And
exemption. So yeah, helping to be able to pass along more of
right,
that farm ground without
right.
it being
And,
completely
and, and
taxed
we
like
don't
crazy.
have an artificial sunset. Now, Congress, if they change to get more progressive, they may reduce it, but we don't have any deadlines right now. It's just going to be permanent at this level.
This may be an inappropriate time to ask this, but the does that does that exemption changes some of that change how you may structure how your land is held, aka a
Yes,
trust versus
yes,
something else? Like,
yeah.
does that
Well,
is
if
that
you
how people should think about
let's say you're worth $40 million and you're married, and a lot of it's farmland.
it? Yeah.
If the farmland is in your individual name, we're stuck with a $40 million value usually. If we then transfer that land into an LLC that owns the land, we
Mhm.
can typically take a discount of 25, 30% on that farmland. So we can drop that farmland value from 40 million down to, let's say, 25 million.
Okay.
That's really what we're talking about.
Yeah.
So
Does
yes.
it how does it work if if a farm couple has that $40 million worth of ground that they own individually as a couple,
Yep.
then the guy dies and all of it passes to his wife, and now she has 40 million, then when she dies to pass on to the kids, does that screw this
No,
thing up?
because then the couple now, they usually will use a trust in that situation to
Okay.
keep his out of her estate.
Yeah.
But even if they used it or didn't do that, they can elect what's called portability. And since he didn't have a taxable estate because everything went to his wife, that 15 million or whatever the number is gets ported over to her.
Okay.
And so when she passes away, she has an exemption not of 15, but of 30 plus inflation.
Got it.
So
Okay,
now
so it
I
kind of
still
takes
like,
care of some of those like need to
yeah,
do funkiness is what I'm
yeah,
really asking about.
yeah,
Like how much fiddling with stuff and games do
yeah.
people have to play here to account for that? And it
It's
sounds
dropped
like it's not
dropped a
that
lot less.
crazy.
Now,
Okay.
what we're primarily doing, we're not doing as much estate planning anymore, worrying about the death tax. What we're doing is we're trying to get step up in basis. So
Mm,
we want to run things through the estate so that if you bought the land for $1,000, now we can step it up to 20. So that's it's more income tax planning than it is estate tax planning. But they're like a teeter totter. You know, you can't go too far one way or the other. So
yep. Got
okay.
it.
Farmers like this, but I've always accused farmers of being a little bit like crack cocaine, 100% bonus depreciation, because you get hooked on it and it's hard to get off of it. Now, Mitchell, I know nothing about crack cocaine, but that's what I've
I was gonna
heard.
say we're
That's
taking a hard turn here on this
yeah, that's what
conversation.
I've heard. So now the key is for 2025, if you bought, let's say, a combine in January, between January 1 and January 19th, and it was delivered on your farm, you're stuck with 40% bonus. It's everything after January 19th is 100% bonus. But you, as the farmer, can also have an election in 2025 to elect to use 40% bonus instead of 100%. Now, we might want to do that if we haven't sold too much and we want to take advantage of that 40%. Because remember, the remaining plus or minus 50% gets carried over to the following years, so we can use it in the following years and so on. Plus, Section 179, we'll talk about here in a minute, is a lot higher. You can use that to optimize your deduction too. But this is good news.
But this is the ability to play with even more aggressive swings at the end of the year to buy new stuff,
Yep.
to
Yep.
offset income, and it's just playing around that game
Yeah.
more aggressively. But to your point of like getting addicted to it, it's like,
Yeah.
well,
Yeah.
you got to keep in mind constantly spending money just to avoid paying taxes
Yeah.
may not be a good idea.
Yeah, and John Deere and Case IH and all those companies love this because it
Yeah, of
allows
course.
they can tell the farmer, hey, you come in and buy the combine. Now, technically, the farmer needs to realize that combine needs to be delivered to the farmer by the end of the year. Just simply buying the combine at the end of the year under tax rules
Hmm.
you can't deduct it. Now, am I saying that farmers never do that? I'll leave that. I'll leave that alone.
It's a different
So
thing.
yeah. Section 199A, most farmers really don't understand this, but I just wanted to bring this up. This is that extra up to 20% deduction. Well, depending if you deal with a cooperative, it could be higher than that. But let's say your farm netted $100,000. The 199A allows an extra $20,000 deduction.
Hmm.
Now, when I say net 100,000, that's after your half of your self-employment tax deduction, self-employed health insurance, retirement plan contributions, and so on. It isn't just what's on Schedule F. So you have to look at all that. They did boost it a little bit. There's a phase out range that for married couples that was $100,000. Now it's bumped up to 150,000. Most farmers, this doesn't apply to because that doesn't kick in until about $400,000 of income.
Hmm.
Most farmers always want to be under that number. Even large farmers somehow find a way to stay under that number. So we'll leave it at that.
Yeah.
Section 179, it's been bumped up to 2.5 million for this year. And then the phase out starts at 4 million. That's about a double, not exactly a double, but it's close to a double. So a lot of cases, if we have a farmer that, let's say they buy $1 million worth of equipment, under bonus, they could deduct the full million. Under Section 179, let's say they could only deduct $500,000 of it because it's limited to your farm income, basically. That extra 5 million then carries over to the following year, and you can deduct it on Schedule F in the following year and offset your self-employment tax. Whereas if you do bonus depreciation, that extra deduction that you didn't really get the advantage of this year, it becomes what's called a net operating loss. It carries forward to the following year. It can only offset 80% of taxable income, and it can't reduce self-employment. So I'm a firm believer in many, many situations of doing full Section 179, even if you can't use all of it in the current year, just because
Yeah.
it helps out with tax planning.
Section 179, that's depreciation schedule.
Yeah, well, it's on the depreciation schedule. It allows you to accelerate the deduction. Now it's weird. We have
Okay.
100% bonus now. So if you don't take Section 179 and you have bonus, you're basically in the same deduction. This is not an extra deduction. It's just the timing of
Yeah,
the.
it's how you elect to do accelerated depreciation when you're not going to do it all in 1 year, but you're going
Yeah,
to do it a little bit different, maybe
yeah,
over a 2 or 3 year window
yeah.
instead.
Yeah, you may say, hey, I don't want bonus depreciation, so I'm going to elect out a bonus. That's fine.
Okay.
And then I'm going to use Section 179 to optimize my income where I want it to be. So
Yeah.
that's what we're talking about. Excuse me.
Hmm.
Uh, for most farmers, this doesn't apply, but if you're a larger farmer, let's say you're a dairy farmer and you also have like a cheese plant, the building, if you build it, started after January 19th of this year, begin it before January 1 of 2029, and then finish it by January 1 of 2031, you actually you can take 100% bonus depreciation on that building. Now, all farm buildings, so like your shop, all those type of buildings, that's 100% deductible now.
Yeah.
This is for products once they leave the farm and you're going to process them. Like I say, a dairy, you're going to do a cheese plant. Under current rules, that's 39-year property. You have to depreciate that straight line over 39 years. Not a lot of fun. This allows you to do 100% bonus on the portion of the building related to production. So the part for the office, parking, and so on, that's still going to be 39-year or maybe 15-year.
So that'd be, I'm trying to think of how it may relate to some of the farmers on here. So yeah, you said processing for cheese or for other
It could be
processing.
a
Yeah.
vineyard that has a
Okay.
winery. It could be you grow apples and you actually pack the
Sure.
apples.
Some type of process.
Yeah, most farmers, you don't even have to worry about this because you get to
Probably
deduct
not a corn
100% already.
soybean. Probably
Yeah,
not a
corn and
corn
soybean.
soybean.
There's nothing on a corn and soybean farm that you can't already deduct 100% already
Okay, got
with 100% bonus. So I'll skip over this because we already talked about that when we were talking about R&D. I wanted to bring this up. This is really not for the farmer, but there'll be farmers on here that under state law, they're required to pay time and a half, like Minnesota. Once you go past 48 hours, you have to pay time and a half. Washington, California, Oregon, Colorado. A lot of those states have to pay time and a half. The law allows the wage earner, so the workers on the farm, if they qualified, to deduct either 12,500 up to 12,500 or up to 25,000 for a married couple. However, it had to be required under Section 7 of the Fair Labor Standards Act of 1938. It's in the 30s, I think it's 38, which then refers to Section 11 that says farm workers are not subject to overtime. So the key is, if you have employees come to you as a farmer and say, hey, you need to tell me my overtime because I know I can deduct it, you have to push back and tell the employees, at least until the IRS tells us otherwise, you do not get the deduction. So farm employees do not get the deduction because
Did you
anything
say
under state
except
law,
that if they're in those specific states, or you're
no,
saying
those states, they
regardless?
don't get it regardless.
Okay.
Now you're in Iowa. Iowa doesn't have time and a half overtime, right?
No, not that
Yeah.
I'm aware of.
The deduction is only for the 50% above regular rate. You don't get any deduction for the regular rate. It's only for so in Iowa, you wouldn't have it anyway, even though you're paying overtime because the worker's working more than 40 hours.
Sure.
That's more than 40 hours. But according to the actual law, there is no deduction for that employee that works as an ag labor.
Yeah, okay, because of this 1930s carve out, essentially.
Right, because of the reference to the Fair Labor Standards Act. Now, there's a couple acts in Congress that they're trying to push through to allow that deduction, but that hasn't happened yet. And the Republicans likely are not going to allow it, maybe, because the most of the states that require time and a half are what I call blue states, and the
Mhm.
Republicans don't like blue states. So we'll see.
Got it.
We'll see.
Got it.
But I just wanted to bring that up.
Interesting.
There is for your local bank, not the farm credit system, but the local bank, your community bank, Wells Fargo, US Bank, whoever it might be. If they make a loan to you as a farmer, a mortgage, they're allowed to deduct 25% of that interest income that they receive from you. However, the interest expense that they pay, because they're going to have interest expense that they pay related to that loan, they have to reduce 25% of that deduction. So the net effect based on a C corporation, their net effect, maybe on an 8% mortgage, they might save 20 basis points. Are they going to give you a reduction in your mortgage for 20 basis points? Probably not. They're just going to keep it. So they wanted 100% deduction. They got 25%. And then finally, for either farmers, so the rule is any farmland that's been farmed, rented, or farmed by a farmer, a qualified farmer, FSA qualification for at least 10 years. And then a farmer has to buy it. So it can't be me. It can't be Bill Gates. It has to be a true farmer under FSA rules, has to agree to farm that land for 10 years. It allows the person selling that farmland to take the portion of the tax related to that gain and defer it for the next 3 years. Now, it's a 4-year deferral, but the first payment is due April 15th. So if you did it in 25, first payment is due April 15th of 2026, no extension. And then each payment for the next 3 years is a 1-year deferral. This saves about 7 to 8%, but allows the farmer maybe to have some extra cash flow for that 3-year period. Now, if they
This
miss a
is
payment, it's all due.
okay, so it's cash flow for the farmer that's buying the ground,
No,
not the
for the
seller?
person selling,
Yeah, the seller.
selling it.
Yeah.
So,
So the
so
purpose of this is for a landowner to be minorly incentivized to sell the land to an
to a
actual farmer.
farm, to a farmer. Yes, there's a little bit of an incentive. Now, the original act that Senator McConnell released would have had 100% deduction for selling, the gain on selling farmland. That did not pass. This is what they did instead. Now, I
Okay.
know in Iowa, my memory is in Iowa, if you've owned it and farmed it for at least 10 years, you get some type of reduction, either 100% or some reduction in that gain and so on. That was the original intent, but instead they got this. So it's helpful. It's a little bit of an incentive. Now, the farmer, they got to be willing to sign a covenant or a deed restriction that says, yes, I'm going to farm this for 10 years. So, I think where this is helpful, there's no related party restriction. So if I have kids and I'm selling my land to my kids, I can elect to defer that tax. So,
Sure.
because the kids are going to be fine. They want to farm it for the next 10 years, no matter
Sure.
what. So, yeah.
Sure. Does this apply when like the old landowner dies, it passes on to the next generation, then they sell it since they
Yeah, that's not going to be as big of a deal because remember, they get a step up in
step
basis in
on
that
basis, so
situation.
the
So they may
tax.
not owe any gain. They might not have any tax.
Okay, got
So
it.
it's really during lifetime more than after than an inheritance.
Yeah.
And then a couple other things, and then I know we're probably running out of
Yeah.
time. Just wanted to mention solar projects are still allowed for the farmer. They want to put in solar or wind, that's fine. They can get the 30 to 50% tax credit just depending on what it is, but it's got to be placed in service by December 31 of 2027. So you got a little bit over 2 years to get that done. If you can combine it with the REAP grant, especially a 50% REAP grant, and you have enough tax liability to soak up the credits, now you can sell them, but remember, it needs to be a big enough credit really to sell it effectively. Your payback, you got 100% all your costs is taken care of between tax savings and REAP grants. That's the only thing I really wanted to say on that.
Mhm.
And then Section 45Z, hopefully by the end of the year, we're going to get some good guidance. We'll find out, but you've mentioned everything to them. And
Yeah.
with that, that's really the end of my slides. I'll go ahead and stop sharing.
No, awesome, awesome
I don't
stuff.
know if we
Hope,
have any questions in there or
yeah, I mean,
not.
there was somebody asked if we could share the slides and stuff.
Yep,
Obviously, it's
yep, yep,
recorded, but if you
yep.
want, maybe
If you want to send out the slides, whoever wants them, that's fine.
okay,
Yeah, you
maybe
have a copy of the
Diana, if
slides.
you want to maybe just send them to at least to the folks that were registered. But yeah, I mean, obviously drinking from a fire hose there,
Yeah.
Paul. Hopefully, folks were following along. I was trying to ask some clarifying questions as I went. It's a lot of stuff that's very new to me as well, and I think all of this boils down to, all right, there's a lot of particulars here that hopefully maybe if something resonated with your operation, you kind of jotted that down or can go back and revisit the
Or
recording.
I guess
But
I'll
really,
do a
it
little.
just warrants the conversations
Yeah.
with your CPA and making sure
Or
that
I'll
they're,
do a little bit of a sales pitch. I've discussed all of these things on the slide
yeah,
in detail on my blog, farmcpareport.com. Yes, it is subscription based. I think it has value. But if you signed up for it, you can search all of those previous posts. There's probably, I've been doing it 3 years on that site, probably 800 posts on there. Probably on OBA, there's probably over 100 posts on there that go into a lot of detail.
okay, okay, there you go. So being able to go in and get some of your content where there's a
Yep.
lot more
Yep.
details. So just tons of stuff. But I think especially it's as you're doing some of that end of year tax prep and stuff like those depreciation things, some of like just how that's gonna be factored into your taxes, just it's there's a lot there, a
Yep.
lot to be considering. So but farmers should be taking advantage of it. Like
Yeah.
where you can, obviously take advantage of it. So,
Exactly.
other than that, one follow up I was going to ask with some of these changes that happen, especially with Title One stuff, is it your take that we're just not going to have Farm Bill in the future
I
because basically all
personally,
got addressed here?
yeah, because remember they already pushed with the quitting the shutdown.
Yeah.
They pushed the 2018 Farm Bill another year forward, so it goes through 9/30 of 2026. I think eventually what will happen is they'll tie that Farm Bill and make it permanent to some legislation, some type of budget reconciliation. They'll make it permanent. Then going forward, they're just going to do tweaks. We're not going to have a 5-year farm bill anymore. That's my personal opinion.
Definitely seems like it's going in that direction, but we will see.
Yeah.
Yeah, if you want more info on the R&D credits we were talking about, hit up just hit me up or hit us up. We've got a free little tool that can walk you through it. We'll continue to have these conversations every Tuesday on the CI Chit Chat. My wife and I are due to have our third child at any point, so all of these, all
Or
this content
contingent.
is it's all contingent on that, but Paul noted it, and that is my update as well on 45Z. Is I was reached out to by some folks at USDA on Monday, where the message was, "Hey, we're working on 45Z. We want to talk." So I'm going to meet with some very high up folks at USDA on Friday, And I hope that we'll
Hopefully we get
see some
something.
movement by the end of the year. Like Paul said, I think we're kind of in alignment there. At least making some progress forward, but we'll find out. So
Okay.
anyway, thanks everybody for hanging out with us here. Hopefully this was insightful. I know I learned a lot. Yeah, Paul, really appreciate it every time. It's always amazing to hang out and really appreciate your time and all of your good work.
No problem. Thanks,
Sweet.
Mitchell.
Thanks
Thanks,
everybody.
everyone.
Have a
Bye
great
bye.
day.